Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
Today we have three big stories for you. First, how TikTok's parent company ByteDance is now out-earning Meta with an incredible $48 billion in quarterly revenue, even while its famous US operation remains unprofitable. Then, we'll look at how a new 39% US tariff on Swiss goods is sparking tariff tourism for luxury watches, and how US customs is using AI to fight back. And finally, we'll break down a surprising signal that commercial real estate is roaring back to life, with investors now bargain hunting in the struggling office market. The most unexpected news in the finance world today has to be this. The company behind TikTok is now out-earning the owner of Facebook and Instagram. Sources say ByteDance, TikTok's parent company, just pulled in a staggering $48 billion in revenue for the second quarter. That's a 25% jump year over year, and it comes after ByteDance already topped Meta's sales in the first quarter. But that amount of cash isn't really coming from the TikTok app we all use. Actually, ByteDance's real moneymaker is its Chinese domestic market. The Chinese version of TikTok, called Douyin, has become a dominant e-commerce platform, a digital mall where users spent nearly $200 billion last year alone. That domestic engine is what's generating this incredible revenue. Fueled by this explosive growth, the private tech giant is launching a new employee share buyback that values the company at over $330 billion. This is where the situation takes a more complex turn. While the mothership in China is printing money, it's facing intense pressure in Washington to sell off TikTok's American operations. And believe it or not, according to sources, that US business is actually unprofitable. So the thing is, how can an app with 170 million American users be losing money? Well, this isn't a sign of failure. It's a deliberate strategy. TikTok is playing the long game, prioritizing growth over profit. They are pouring billions into infrastructure like data centers, marketing, and crucially, massive content moderation and legal teams to fight constant regulatory battles. They're spending to win the war for market share, even if it means losing the battle for short-term profit. This all leads to a massive disconnect on Wall Street. Even with a $330 billion valuation, ByteDance is worth less than a fifth of Meta's nearly $1.9 trillion market capitalization. Analysts say that gap is almost entirely due to political risk. And while political risk is a huge part of it, this valuation gap also reveals a lot about how Wall Street thinks. For one, ByteDance is still a private company, and private companies are almost always valued lower than public ones like Meta because their shares aren't as easy to buy or sell. On top of that, ByteDance's profit margins are actually shrinking as it invests billions in new areas like e-commerce and AI. So investors are looking at not just the revenue, but the massive costs and the uncertainty that comes with being a private Chinese-owned tech giant. A consortium of American investors is already lined up as a front runner to acquire the app, and Donald Trump has extended the divestiture deadline to September 17th. So the billion-dollar question isn't just who will own TikTok. It's how a company can be winning the revenue war against Meta while its valuation is held hostage by geopolitics and its most famous asset in America doesn't even turn a profit. All market data is subject to change. This is not investment advice. Speaking of geopolitical pressures creating unexpected ripples in the market, a new 39% US tariff on Swiss goods just went into effect, and it's creating a frenzy. Wealthy Americans are now flying directly to Geneva, not just to ski, but to hunt for a loophole. One New York couple is planning a trip with a budget of up to $75,000 for a single Patek Philippe watch. Their goal? Buy it abroad and sidestep a tariff that could add thousands to the price tag. And this trend, sometimes called tariff tourism, isn't just a quirky story about the rich. It's having a real impact back home. US-based luxury retailers, the authorized dealers for these brands, are feeling the pain. They're forced to either raise their prices significantly or absorb the tariff costs, which hurts their bottom line. Some reports show US prices for these watches have already jumped by 12 to 14%, and the numbers are staggering. An analysis shows a Rolex watch that retails for $11,300 could cost nearly $16,000 after tariffs are applied. That's a potential $4,400 hit. Interestingly enough, the luxury brands themselves are in a tough spot. They're worried about this creating a grey market where their products are sold through unauthorized channels. To fight back, companies like LVMH are embedding things like RFID chips inside their products to track them from the factory to the store, trying to control where their exclusive goods end up. The strategy is so popular that one luxury travel advisor reports shopping-centric trips have spiked 48% this summer. It's not just Switzerland. With a 15% tariff on EU, goods, France and Italy are now hotspots for luxury fashion from brands like Hermes and Prada. But here's the multi-$1,000 catch. US Customs and Border Protection requires travellers to declare all items acquired abroad. One Logistics CEO put it bluntly. For a $10,000 watch, you will have taxes you need to pay. There is no way around that. And trying to get around it is getting harder. US Customs and Border Protection is deploying some serious technology using artificial intelligence to analyze travel data in real time and flagging individuals who might need extra scrutiny. The AI even scans open source information and social media. So if you're bragging about your new watch online before you land, you might be in for a surprise at the border. Failure to declare risks, fines, and forfeiture of the goods. So is this whole gambit a bust? Not exactly. The real play might not be about dodging tariffs, but about exploiting another system entirely, Europe's value-added tax, or VAT. American travellers can claim refunds on it, often getting more than 15% back. Now, companies like Global Blue have long managed these refunds, but it's often a slow paper-based process. A new wave of fintech startups is disrupting the game with AI-powered apps that let travellers reclaim their VAT money directly on their phones, sometimes in under 48 hours. That refund can then be used to offset any duties paid at the US border. This presents a fascinating duality. On one side, you have governments using tariffs, while on the other, you have savvy travellers using technology to leverage a different tax system to their advantage. It seems that for some, this is about more than just money. Research suggests that for certain affluent individuals, finding these loopholes is seen as a victimless act, a sort of gamification of wealth. It raises a bigger question about fairness and who ultimately carries the tax burden. We were just talking about how AI is being used to enforce financial rules. Well, it's also being used to find opportunities in a market many had left for dead, commercial real estate. Just when you thought the sector was down for the count, there's a major signal the market is roaring back to life. For the first time since December, a key global index measuring bidding activity just saw a major improvement. Now, to understand why this is a big deal, you need to know this isn't just a simple survey. The JLL Bid Intensity Index is actually made up of three key metrics: the gap between seller and buyer prices, the number of bids per deal, and how varied those bids are. When all three of those signals move in the right direction, it tells us the market is genuinely getting healthier. This isn't just a minor uptick. It's a sign that after months of uncertainty, big money is moving off the sidelines. But that's not the whole picture. The real turning point is where the activity is heating up. The office market, left reeling from its COVID-induced crash, is suddenly showing signs of a comeback. It appears investors are now on the bargain hunt, driven by a growing number of bidders and lenders willing to quote on office loans. And here's where it gets interesting. This isn't just about waiting for everyone to return to their cubicles. Many of these investors are making a totally different bet. They're pioneering new models, converting underutilized office buildings into residential units, labs, or mixed-use hubs. We're seeing this in cities like Pittsburgh, where a former headquarters is now a 253-unit apartment building, and Calgary, which is using city incentives to create thousands of new apartments from old office towers. They aren't just buying office space, they're buying the raw materials for future city living. When we place the struggles in the industrial sector alongside the boom in living spaces, the shift in investor strategy becomes clear. The industrial sector isn't just lagging, it's transforming. Investors are becoming much more selective. They're shying away from dumb warehouses and actively seeking properties built for high-tech, automated future facilities designed for robotics and micro-fulfillment centers. And that booming living sector is being supercharged by technology. Huge institutional landlords are now using sophisticated PropTech software platforms to manage thousands of properties at once. These algorithms help set rental prices and manage maintenance, but it's also raising new ethical questions about fairness, especially with recent lawsuits alleging that some of this software could be used to coordinate pricing and drive up rents. So what's the real endgame here? According to JLL's Chief Research Officer, Ben Breslau, investors are accepting uncertainty as the new normal and moving into a risk-on mode. And accepting uncertainty isn't just a feeling, it's a calculated strategy. Investors are now using advanced data analytics and AI-powered models to price non-traditional risks that were once unquantifiable, things like climate change impact and supply chain fragility. These AI tools can reduce loan default rates by spotting risks early, allowing for smarter bets in a world full of unknowns. With what Breslau calls exceptionally strong debt markets and a clear shift in investor psychology, the evidence points to continued growth in capital flows. The game has changed, and the quiet pullback in commercial real estate may be officially over.
That's it for today on Valuation Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.